It happened. The Fed raised its short-term rate today by 0.5 percentage point. This marks the sharpest increase since 2000. So widely expected, the move will ripple through the economy, no doubt. So why the raise? Well, the intention is to combat the highest inflation in 4 decades. The higher rates will make it more expensive to buy a home or a car or carry that credit card balance. The Fed began increasing rates by 0.25 percentage point after lowering them to nearly 0 during the pandemic. So today's increase will accelerate the impact of American wallets from gradual to more sudden. So over the past decade, rate increases and rate cuts were smaller and happened more slowly. This faster pace makes it more important for consumers to pay close attention. Why? Well, because the latest Fed rate change will affect your money. How does this intersect with real estate? Well, over the last 2 years, the low rates and the low housing inventory ignited, as you know, a fiercely competitive housing market. House hunters encountered high prices and bidding wars. And as of March of 2022, as I've mentioned in other reports, the median sales price of a single family home reached $375,500. This is nationwide at 15% year over year, according to National Association of Realtors. The mortgage rates are based largely on the yield of the 10-year U.S. Treasury bond. This rate is used as a benchmark for many types of loans, including mortgages. When the Fed raises the rates, this pushes the yield on the Treasury note higher, which will then push mortgage rates higher. The Fed signaled higher rates earlier this year. The 10-year yield moved higher. When it rose, the average rate on a 30-year fixed mortgage rate rose, which was 5.1% as of a week ago, April 28, according to Freddie Mac. A year ago, the same rate was 2.98%. So, it's been happening slowly. Now it's going to happen much faster. So anxious home hunters should look at the broader historical context. A 5% mortgage rate is still considered low. Yes, mortgage rates are higher than they were a year ago, but if you've done the work and you've saved the money and it makes sense in your financial plan, then it still makes sense, because this shift isn't going to make that much of a difference for you. So you might have to be more cautious in how much house you're getting, so you make sure you have a really good handle on your monthly payments. But of course, you're not qualifying for that loan anyways if you can't afford the monthly payments going forward. So yes, it will affect everybody's wallet, checkbook, pocketbook in some way, shape, or form. But we're going to get through this like we do most everything. So until next time, Debbie Lucas.